Good afternoon, everyone. Thank you so much for joining us today. We have a world of things to discuss concerning retirement. We're going to talk about Social Security, Medicare, and then just some general retirement issues. We have Art Rhodes with us, who is the president and CEO of the Church of God Benefits Board, and he is our wealth of knowledge. So we're going to jump in pretty quick, but why don't you go ahead and say hello to everybody, and then we'll get started.
Well, thank you, Angie. I appreciate the opportunity to be with everybody today and talk about some issues that I think are really critically important for us as we begin to prepare for retirement. You know, I generally now tell people their age based upon how many years they are until 70. So that's kind of my new target. So I tell folks, okay, well, you're 57. That means you're 13 years until you're 70. So anyway, I think we're going to talk about that today, but I'm not saying that for anybody other than myself. Okay, I certainly don't want to talk about
Thanks for clarification.
I'm not going to talk about women's age today.
We greatly appreciate that. Well, again, we have so much to cover today, so let's go ahead and get started first. And I think we'll start with Social Security, if that's okay. That's one of the issues we get an awful lot of questions about from our participants. So can you give us just a brief summary of why Social Security was created and what it's supposed to be for?
Well, Social Security program was created back in the 1930s. And while a lot of people believe it's a retirement program, that was not the intent nor the goal of the Social Security program. Our goal was, the goal of Social Security was basically to provide supplemental income to people in their retirement years. And so, again, a lot of people use it for different purposes now and think that's supposed to take care of them in retirement, but it was never that case. Ministers kind of have a unique status in Social Security in that prior to 1968, ministers were not included in the Social Security program. They actually had to sign in or enroll in Social Security. And in 1968, the law changed, put everybody in the Social Security system. And then for ministers, it allowed them an opportunity to opt out. And I know we may talk about that a little bit. We certainly never recommend ministers opting out of Social Security. There's a variety of reasons for that. But from 1968 on, they could.
Okay, very good. Well, let's start by who is entitled to Social Security. Is everybody that breathes entitled to Social Security when they reach a certain age, or how do you qualify?
No, you have to work and have to contribute to the Social Security program to be eligible to participate. And not just one day, you have to work on a consistent basis. You have to contribute to the Social Security system for at least a period of 10 years or 40 quarters. Once you've contributed 40 quarters to the Social Security system, then you're eligible for Social Security retirement. Now, there's Social Security disability. We're not going to have time to talk about that today, but different qualification rules for that. But for Social Security retirement, you have to work 40 quarters, again, 10 years worth of work. And to qualify as a quarter, you have to make at least, and I'm checking my notes here, you have to make at least $1,320 per quarter for that to count as a quarter for Social Security purposes.
Okay. Well, once we do reach retirement age, how is the benefit calculated? How much is my check going to be, and what is that based on?
Well, I figured you were going to say, is it based upon my highest 3 years of earnings or my highest 5 years of earnings? Because that's typical of what people think. And you've probably heard people say, well, I'm going to work a few more years to build up my Social Security earnings, so they use those years. Well, in reality, Social Security is based upon your highest 35 years of earning history. So if during that 35 years, if you have years where you didn't work, those go up as zero. So working longer does help, but it doesn't determine what your benefits are. If you've got 5 years of making $100,000 a year, but you've got 30 years of making zero, then all of that gets calculated in together to determine what your benefits will be for your Social Security.
So those years that you didn't work counts into the average.
That's right. Top 35,
35.
35 years, yes.
Okay. Once my check is set, is there a way to increase or decrease what the benefit might be? Or is it set for life once you enroll?
Well, there's actually two ways to increase your Social Security benefits. One's continue working.
Okay.
And we'll talk about that a little bit. And the other is there's something called a COLA that everyone gets that's drawing Social Security. A COLA is a cost of living adjustment that the Social Security Administration makes. And for 2018, they've already announced that COLA is going to be 2% for 2018. It's not guaranteed every year. There's been a couple of years over the past 10 or so years where there was no COLA, that participants did not get an increase at all. But the other way I mentioned is that you can continue to work. And if you are drawing Social Security and continuing to work, your benefits could actually go up if those years are higher than your previous 35.
Okay.
Okay. Now that's until you reach the age of 70. And again, these rules become real complicated. The other huge way to increase your benefits is to delay taking your Social Security until you're the age of 70. So for instance, young people like me, I say that with a smile, young people like me that were born from 1960 until now, their full retirement age, and that's a technical term for Social Security, full retirement age is 67. So I happen to be born in 1960, so everybody can do the math of how old I am. I am 13 years from 70, but I was born in 1960, so I have to, my full retirement age is 67. But if I delay until I'm 70, for each year that I delay, in my case it's simple, for each year that I delay, I get an 8% increase in the amount that I draw.
Okay.
So, and that could be cumulative in my case of 24% if I make the decision to work to 70. So just the simple math of that is if I were going to draw $1,000 Social Security benefit and I delay that until I'm 70,
Right.
I'm now going to draw $1,240. That becomes my base amount upon which my COLA now is based for years to come, rather than $1,000. So $240 a month for delaying those 3 years, that's a pretty substantial amount. And if your Social Security amount's $2,000 a month, you can just do the math. It adds up to, it could be, pretty sizable, pretty significant. It's probably a better term.
Okay. Well, can you work past 70 to 71 or 72 if you choose and continue to get any kind of benefit?
Well, you can work as long as you like.
Okay.
That's what I tell people the benefits board anyway. You can work as long as you like. We want to keep you working. Just work. But actually, there's no benefit in delaying taking Social Security after 70. You don't get any additional credit for delaying. So even if you are working, once you reach 70, you should start drawing your Social Security.
And that 8% per year stops at 70.
It stops at 70,
Okay.
yes.
Well, let me ask you this. Let's say my spouse and I are both drawing benefits from Social Security and my spouse dies. Do I continue to receive both checks as long as I live, or what happens with the checks at that point, or the benefits?
Are you a minister? Because that sounds like a question that a minister was asked. They always trying to figure out how to.
I just want as much as I can, minister or not.
Well, and then of course we have to ask how your spouse died, but that's another story too. No, the answer is no, you don't get both checks. If your spouse passes away, you are entitled to a spousal benefit, which means that you get to choose, and you have to actively make a choice, but you get to choose which check you get. Well, it's pretty simple for most people. You just choose the one that's the most. So again, I'll use a simple example. Let's say that your spouse is drawing $1,000 a month Social Security, and you're drawing $800 a month. He passes away, then of course you would want to choose to get the $1,000. but you don't get the 1,800. You don't get both. You get only the one that is the highest, but you have to actively choose that. And it sounds more complicated than it really is. When you notify Social Security that your spouse is deceased, provide a death certificate, then they're going to work with you and give you the advice that you should do that. And contrary, and I want to say this, contrary to what most people believe, the folks with the Social Security Administration are very good at trying to help you get the best benefit possible. And because they understand, they're just like you. They've got to survive in retirement, and they're willing to do that. And there was all kind of old rules. There used to be rules called file and suspend and all those things. Those have now gone away. But again, the Social Security Administration is willing to work with you to help you get the best benefit possible.
Okay. One other question on Social Security that I have is, are my benefits taxable, or have I already taken care of that before as they were paid in?
And that's another wonderful question, because most people think, well, they took that out of my paycheck and I've already paid taxes on that, when in reality, you really haven't. And now potentially your benefits could be taxable once you get to retirement. The base rule, and again, there's all kind of variations. Anytime we deal with taxes and benefits, there's variations. But the base rule is, if you are single, then you can have outside income up to $25,000 currently, and your Social Security benefits would not be taxable. If you are married, you can have outside income up to $32,000, and your Social Security benefits would not be taxable. If you make more than those minimum amounts, then a portion of your Social Security could be taxable. Up to 85% is taxable. Not mean they're going to take 85%, but up to 85% you might have to pay taxes on.
Okay. Well, that covers my questions. Is there anything else on Social Security before we move to our next topic that you'd like to cover?
Well, I guess the big question that I always get about Social Security is, when should I start drawing? Should I draw once I'm eligible, which is actually 62? So you could take a reduced benefit at 62. Or should I wait to my full retirement age, which again is now 66 plus years? Or should I delay until 70? And I think that's the bigger question for most participants that we talk with, as to how should I go about looking at that? What should be my perspective on when I should take those benefits? And I'll just tell you, it's for every person, it is different. Some people should start drawing early. Most people, however, should wait until they are at least at their full retirement age, and some should delay until they're 70. What you do need to know is, if you do start drawing at earlier, prior to your full retirement age, you can lose some of your Social Security benefits if you make too much money. There is what is called the earnings test, and for 2018, it's roughly $17,000. It's $16,900 this year. 2018 will be $17,040 that you are eligible to make without having to worry about your Social Security. But if you make more than that $17,000 amount, then you may lose some of your Social Security. You actually lose, for every $2 that you make above $17,040 next year, you'll lose $1 worth of benefit. So generally, for most people that are working full time, and certainly making more than $17,000, you would not want to draw Social Security, because you could lose your benefits from doing that, or lose some benefit from doing that.
That makes perfect sense. Okay.
But those are the basic things.
Those are the basics. I know there's all kinds of exceptions and different things that apply to every person's situation. So I appreciate all of that on the Social Security. Let's move along to Medicaid. That's another fun one that is just
Medicaid or Medicare?
Let's do Medicare first.
Medicare.
We'll do Medicare. It's like health insurance. It seems to just be a mess, really, and very confusing.
Yeah.
I hear all about these different plans. There's a Part A, a Part B, C, D. I think that's all. But can you give us just a little bit as we keep going? Okay.
It's kind of the bingo of things. Well, Medicare is tied in with Social Security, and it's tied in through what most people know as FICA. When you make $100, if you're working at Walmart or wherever you're working for a church, you don't get $100. You have to pay taxes on that, plus you have to pay Social Security and you have to pay Medicare. So most people don't realize that out of every dollar that you earn, you have to pay $7.65 for Social Security and Medicare, generally called FICA. 6.2% or $6.20 out of 100 goes to Social Security. $1.45 goes to Medicare. What most people, again, don't realize is that the employer in a regular employment situation has to match that. So actually $15.30 is going in rather than just $7.65. So, and again, it's the same division for the employer going to Social Security and Medicare as well. But Medicare is basically health care for folks after 65.
Okay.
So you're not eligible for Medicare under normal circumstances until you reach 65. There are some situations where you might be disabled that you would qualify earlier, but normally you have to be 65 to draw. The other important part, and I know you probably have a question about when do I sign up and do I have to sign up or does it automatically come? Am I asking you?
You're going right on through it. Just go ahead.
Remember that one. We'll come back to it. But let me just talk about what Medicare really is. You mentioned there's really four major parts of Medicare. Part A, Part B, Part C, Part D. That's pretty simple. Part A comes with Medicare. It is the original Medicare. Everybody gets Part A basically free. That's what they say. Part A covers, and again, we're generalizing, but it covers your hospital coverage. Part B is more physician and more specialized coverage. And then Part C, let me jump over that and just go to Part D first. Part D is prescription coverage.
Okay.
Now, for Part B and Part D, you have to pay for that. And that generally is a deduction from your Social Security to pay for the doctor's part, which is Part B, and Part D, the prescription coverage. Part C, Medicare Part C is basically it's the Medicare Advantage program, and it kind of combines A and B together, and then there's an outside provider, and that's a very complicated discussion. So generally, most folks are in Part A, Part B. Fewer people now, some a little more than in the past, are now going into Part C. But Part C is kind of an outside provider doing Part A and Part B, and sometimes with some prescription coverage as well. Is that totally confusing?
Completely. But we at least have an understanding, I think.
Yeah, just an understanding that Part A comes with it.
It's included.
It's
you
included.
Paid for it already, basically.
Theoretically, you've paid for it already. And then Part B, you have to pay extra for. Part D, you have to pay extra for prescription coverage.
Okay. Now, you mentioned that I'm eligible for this when I turn 65 years old. Am I automatically enrolled in Medicare, or do I have to do anything, take any kind of action in order to receive these benefits?
Well, with the government, there's never anything easy. So you have to actually enroll. And it's critical that you know when to enroll, because under Medicare, you can enroll up to 3 months prior to your birthday when you turn 65, the month you turn 65, and 3 months after you turn 65.
Okay.
So you have a 7-month window of opportunity there where you can enroll. If you do not enroll during that period of time, you're subject to a fine. It's not a fine, it's really a penalty, but it applies for the rest of your life. So it's very critically important that you apply during that 7-month window of time. Now, they're going to send you notifications and all those things, but you need to make sure you do that. The only exception, well, I should say only, because in everything there's multiple exceptions, but the primary exception to not enrolling, why you would not enroll, is if you have employer-provided coverage. So if I'm 65 and I'm still working at the benefits board, and I have employer-provided coverage here, then I could just not worry about applying for Medicare and just move forward. But once my primary coverage, my employer-provided coverage ends, I have now an 8-month window of time. They give you 1 extra month, an 8-month window of time to go and apply for Medicare. And if I don't, then that penalty that I talked about earlier applies in that situation.
Again. Okay. What about for our ministers? You mentioned earlier when we were talking about Social Security that they can opt out of paying Social Security. Now, if they don't pay into Social Security, are they eligible for Medicare?
This is, again, I mentioned it in passing because it's a topic I don't really like to talk about, but we are seeing more and more of our ministers who have opted out of Social Security. They made a financial decision to opt out, when in reality the law says you've got to make basically a religious objection. You have to have a conscientious objection to the receiving of government assistance. Now, I find a lot of people who are opposed to paying the tax. I'm one of those. I don't like having to pay taxes. I haven't found anybody that does. But you have to be conscientiously opposed to the acceptance of benefits to get out of the program. For those ministers who have opted out of Social Security, most do not realize that they have also opted out of Medicare, unless they have that 40 quarters worth of secular work where they've qualified for retirement benefits. So let's assume, for instance, we have a minister who is 25 years of age. He goes into the ministry. Under the rules, to opt out, you have to opt out in the first 2 years of your ministry. There's some other criteria, but primarily the first 2 years. He opts out of Social Security. And his reasoning is, I can make more money if I take this and put it into my retirement account and all that. The problem is that generally doesn't happen. And all of a sudden they're worried about retirement at a later point. But if he's opted out and he gets to retirement and he does not have secular work that brings those 40 quarters that we talked about, he is out of Social Security and he is out of Medicare. And while there are ways that you can enroll and pay to be in Medicare, most people who have done that can't afford that. It's very expensive. So again, while you may think Social Security is going to go away, I tend to disagree with that. But while it is critically important you stay in the system primarily just for that Medicare benefit, because that's a huge when you're thinking about, now I don't have anything to take care of me in retirement. And what we find is a lot of people, because of health reasons, now they're 5, 6 years away from retirement. They may have 10 or 15 quarters in. They're now going back to work and being bivocational just so they can get back into the Social Security system.
And that's the difficult thing at that age, to try and pastor and work a secular job.
It really
is.
is.
At any age, but especially as you're reaching retirement.
My hat's off to bivocational ministers, but it's very difficult to be at that stage of life and having to do that.
Right. Well, earlier I confused Medicare and Medicaid. So tell us what the difference is, because sometimes I think people do interchange the two.
Well, there's a world of difference between Medicare and Medicaid. Medicare, as we've just talked about, is based upon your age. You get to 65. It is not the same as your Social Security retirement age. Now, there's some discussion that it may move to that, but right now you are eligible for Medicare at the age of 65. So it is age-based. Everybody who is in the system, again, the Social Security system, is eligible for it. It's not based upon need. So if you're wealthy, you get it. If you're poor, you get it, as long as you're in the system. Medicaid, on the other hand, is based upon need. It is a need or needs-based program. It is for those who are in need of medical care and they have lesser income. It's called different things in some states. For instance, in Tennessee, it's called TennCare. It's depending on what state you're in, depends on what it's actually called. Most states just call it Medicaid. But Medicaid is a federal and state program. So you will see those rules differ by state. So the level to qualify for benefits are a lot different in Tennessee than they are in California or New York or maybe Mississippi. World of difference. Where Medicare, nationwide, same program. Some states, Medicaid is funded at a great level by the local state, and in other states, it has little to no funding. It's primarily all the federal funding. So again, different benefits levels for that. And most importantly, the primary thing is Medicaid is needs-based. It only goes to those who have financial needs.
Well, you mentioned early on when we started, when we were talking about Social Security, that was designed to be a supplement for retirement.
Yes.
So let's talk a little bit about retirement planning, if you'd like to move on to that. Give us an example of why we need to do retirement planning and the best way to get started.
Well, most importantly, I think the key is when we look at what the average person is drawing from Social Security. And that number, and I was just checking my notes, is roughly $1,340 a month. Is what the average person in America is drawing right now, Social Security. Now I know some of you are drawing more than that, some of you are drawing less. So, but that's the average, $1,340. When you think about that, if you have any rent, car payment, any of those expenses, plus your utilities and food, you can't survive on $1,340. So you have to have something outside of that. All of us are still looking for that rich uncle or aunt or somebody that doesn't have any heirs to leave us all their money. And I haven't found that in my family. So I know maybe you're better off than I am in that regard. But most folks are going to have to make it on their own, and there's not someone out there to take care of them. And that's why retirement planning is so critical. And it's so critical to start at a younger age and start preparing young. You don't have to contribute as much. It's always amazing that the folks who start early get in there regular contributing. They can build that big retirement account that they'll need.
Okay. Is there a difference in pension plans and retirement plans?
And I generally use those terms interchangeably, that pension and retirement plans are the same, and when in reality they're not. Pension plans historically are those funds that have been created by the employer in the past. They fund it, and then based upon your years of service, your salary, several other factors, then you get a check for your life after you work so many years. You don't have to worry about putting money in there. It's just there, and then you get to draw out of it. Even the government used to have a program like that has now kind of gone away. And the retirement plans, though, are more the 401, 403 plans like we offer here at the Benefits Board through the Minister's Retirement Plan. Those are true retirement plans. And a retirement plan differs from a pension plan in that a retirement plan is you get out of it what you put in plus your earnings.
Okay.
So if I put $10 into my retirement account, I'm not going to be able to draw, $1,000 a month for the rest of my life. I'm going to be drawing off of my $10. Where in a pension fund, the company is putting money in there and taking care of you in retirement as well.
But a good thing to note about that is that $10, if you save it at 25, is going to earn a whole lot more over the course of your working years than if you wait till 40 or 50 to start saving.
That's right. That $10 a month. Can you imagine what that adds up to it seems like so little, but it begins to add up, particularly when you look at the interest. Now, you're not going to be able to retire on contributing $10 a month to a retirement account. You're going to have to contribute. And so the question again always is, well, Art, how much should I contribute to my retirement account? And probably the easiest and best way to look at that is if I'm going to pick a figure, I would say at least 10% of your take-home pay should be going into your retirement account. That's whether you're making $100 or that's whether you're making $10,000. Put 10% in, and you're going to get close to where you need to be if you start at a young age. Now, if you're 60 years old and want to retire in 5 years, putting 10% into your retirement account is not going to get you there. I'm just telling you, folks, it's not going to happen.
Right, again, start early.
Start early.
Sure. Well, if I am a member of your benefit plan, do I have to take retirement at a certain age? Is there a requirement there, just like there is with Social Security?
No, there is if you're not working.
Okay.
And I've had conversations today with folks about this issue. If you've contributed to your retirement account and you are retired, and again, we use that term, and I want to explain that a little bit. If you're retired, once you reach the age of 70 and a half, you have to start taking what is called required minimum distribution, or RMD. And there's a formula of how you do that and how much you have to take. But at 70 and a half, if you are retired. Now, as a non-minister, that means if I'm not working for the employer that provides the plan, at 70 and a half, I got to start taking that. If I have an IRA, it doesn't matter. At 70 and a half, I've got to start taking out of my IRA. However, if I'm working for a company that provides a retirement plan, like the minister's retirement plan, and I am still working at 70 and a half, I do not have to take that required minimum distribution. And if I'm still working at 80, 85, 90, or 100, God forbid, I still don't have to take out of that account. It gets deferred until you retire.
Okay.
So if I work till 72 and retire, then afterwards I would need to start drawing out of my retirement account at least that required minimum distribution amount.
Okay. And it does mean working. So if I had other investments that I were getting benefits from or receiving money from, that doesn't qualify.
That does not qualify, but for ministers, and that kind of threw me into the ministers, for ministers, working does not mean I'm pastoring a church, does not necessarily mean that I'm pastoring a church or that I'm a state overseer or I'm something in some kind of role. What it simply means is that I am reporting active.
Okay.
So let's say I'm 72. As long as I'm reporting active and I'm sending in my reports, I'm keeping up with my reports to the state and international offices, the IRS so far has never questioned that. They see that as an ecclesiastical matter and allow the church to determine whether or not that person is active. So far, again, they have not questioned that.
Okay, very good. The Benefits Board recently started offering Roth accounts. Do you recommend investing in your traditional accounts or your Roth accounts, and why?
Well, for ministers, as long as the housing allowance exists, then they should be investing in the traditional account because you get the advantage of investing, not having to pay taxes, your account growing without having to pay taxes on it, and then being able to claim it in retirement as housing allowance. So for all of our ministers, I would just simply say, yeah, you should be in the traditional account. Now, we have offered the Roth accounts. For those of us who are not ministers, then that gives us the opportunity to better plan our taxable income as to whether or not we want it to be taxed now or taxed later. Generally, for most people, they're better off having their income taxed now because most people are in a higher tax bracket in working time than they are in retirement time.
Okay. I hear in the news a good bit about tax reform and Rothification. How does that play into all of this, and should I even be concerned about it?
Well, Rothification, that's a great term, and you have to have be able to roll your R's to be able to say that. There has been a proposal to make all retirement accounts Roth accounts or after-tax accounts. In the initial tax bill that has just been released in the last few days, that is not included, but I would just simply say we're not out of the woodwork there. For right now, the tax reform bill looks as though it is not going to change retirement and retirement planning. But stay tuned, because that could change literally overnight. And there's been actually the chairman of the House Ways and Means Committee has said he thinks that's a way to do this. And this is not an issue where it's Republican or Democrat. Both Republicans and Democrats and independents are saying this is something we should look at. And I have a different viewpoint on that. I think they're not taking a broader, bigger picture. But anyway, this whole idea of all retirement accounts would be Roth accounts or after-tax accounts going forward is something that is actively being discussed now and something that is on the table.
Okay. Well, we're running out of time here. I know we've only scratched the surface, and probably many of you have a lot more questions. But as we wrap up, tell me a little bit about this incentive that the Benefits Board has for if you join your retirement plan now.
Well, for the last 3 years, the Benefits Board has offered a $500 matching incentive to participants who enrolled in the plan, to new participants. So what that means is you, for the first $500 that you contribute to the retirement plan, we match that dollar for dollar. And again, I know it's the second week or so of November, so we're running out of time this year. But I would encourage participants who have not enrolled in the plan yet to enroll now. They could, if they contribute $500 between now and the end of the year, whether in one contribution or multiple contributions between now and the end of the year, we will still match that dollar for dollar. So if you put in $500, you're going to get $500 free dollars added, plus your earnings and your interest on your account. So it's a great opportunity to double the first $500 between now and the end of the year. So simple way to enroll in the plan. That's always a question. We don't send out packages and all that. Go to our website, benefitsboard.com, and click on join the plan. And literally in 8 to 10 minutes, you'll be a member of the plan. You'll get information back from us electronically, and you'll be ready to contribute and start building a retirement plan for your future. And again, you're going to get out of it what you put in.
Thank you so very much. We are running out of time. And again, I know there are many, many questions that many of you may have. You can email us if you don't find information on our website, which there is a lot of information there. Art gave you the website. It's www.benefitsboard.com. And there's a tab called Resources. And there's all kinds of information about retirement planning, Social Security, et cetera. And we also put news updates on there as well, so you can check there periodically. Or if you don't find what you're looking for, feel free to email us. Our email address is webinar@benefitsboard.com. And again, Art, thank you so much for all of this information. It's been a pleasure to talk to you, and it's been very helpful and very informative. And I just want to say thanks for taking your time, and thank you for helping our participants.
Thank you, Angie. I appreciate being with everyone. I hope everyone has a great Thanksgiving and a wonderful Christmas season, and we'll see you back soon.